Alright, this is a video for Money Education 101, and what we have today is a home mortgage amortization table. So, this is for a home buying scenario. So, what I'm going to do is walk through how I made this spreadsheet and just a couple of things and why I really like this and how it helps me. So, this first field that I have right here is the house sale price. So, let's say for an example that I was buying a house that was $200,000. Let's say I put a down payment of let's say 50% or 10%. So let's say we put a down payment of $20,000, which is a pretty decent down payment. But let's say that there was $2,500 in closing costs. So that next field you can see that we have right here is the loan amount. That's how much money I'm going to borrow from the bank, $182,500. Now, what we can do is we can put in an interest rate. So let's say we got qualified for a 4.5% interest rate, which is kind of a standard right now depending on your credit score, but it's kind of the national average for what an interest rate would be for a home, 4.5%. The number of years would probably be 30, unless you wanted to do like a 15-year mortgage, and you could put that in here. You can see that your monthly payment would be $924.70, that next field there. But let's say we did want to pay it off in 15 years. You can see that payment just went up to $1,396. So I'll keep it at 30 for the sake of this video. So our monthly payments there. This next box here is the scary one. So the home that we're buying, or the loan amount that we're taking out, is $182,000. The total interest, just interest, not principal, that we're paying over the term of the loan for those 30 years is $150,000. That's a lot of money. That's a lot of money to be paying in interest that's not even going towards the principal of your home. And so for a total of what you paid for the house, including the principal, which is that original $182,000, that loan amount, well, I guess you paid $200,000, but with the down payment and closing costs and everything, rather than paying $182,000 for your home, you're paying $332,000 over those 30 years for your home. So you better hope that it increases in equity if you're going to take out and pay that monthly payment, or the minimum monthly payment. So the thing that I like about this spreadsheet is that I've created an additional scenario that I'll show here. So what this is it's the extra payment. So we can put extra payment in there. So with this scenario here, you're just buying the house, you're making whatever the mortgage lending company is asking, you're making that minimum payment there of $924 to them, and you're paying a lot of interest. But over here, I've set up an equal scenario, and I failed to mention that I have the month's interest, the principal, and the balance. So for the first month, month one, you're paying $684 in interest, and you're only putting $240 towards your principal. And that goes on. See, I've got this as a amortization table, so it continues all the way down to the 360 months that there would be. I also have this little chart over here that charts the interest versus the principal. So this is the interest. So you can see on day one of that loan, or month one, a lot more money is going towards interest than towards the principal. But over time, your interest goes down and more of the money that you're paying goes towards your principal. So that's just a cool little thing. So let's go back to this extra payment calculator that I have here. So what this is saying is, let's say I had an extra $200 a month that I could pay towards that $924 a month payment. So instead of paying $924, I was paying close to $1,200. So I've put in that $200. This is going to allow you to pay your home off sooner. As you can see, it will only take you 251 months rather than the 360 months over 30 years to pay off your home. That's a savings of 109 months. But that's 9 years. So instead of taking 30 years to pay off your home, you're knocking 9 years off of that. So it's only taking about 21 years or 20.8 years to pay off your house. That's the amount of interest that you're paying. So as you can see, you've saved $51,000 in interest just by making an extra $200 a month towards your mortgage. Now, a lot of mortgage lending companies, they will let you do this. They'll let you pay it off sooner. Obviously, it's better for them because they're getting their money back quicker, but also and less chance of a foreclosure, but also it's better for you because you're paying less interest. So $200 a month, that's not a whole lot to be putting away, especially to save you $51,000 over the term of the loan. That's a lot of money. I don't care who you are, that's a lot of money to be saving. So I can do this really quick. So your payment, you'd be making the 200 plus the 924, so you'd be making just over $1,100 monthly payment. So a lot of people will pay more than that in rent. So let's say you had been renting a house for someone and you'd been paying $1,500 or something along those lines. So let's say you could actually afford another $400. You see that the interest difference here, that just keeps going up. You know, you're going to continue to save yourself money. The more money you put towards this, the better. Let's say you could afford an extra $1,000 a month. You see that you saved yourself 20 years. You're able to pay the house off in just over 10 years. So that's a beautiful thing. So if you're someone like me that doesn't really like paying a lot of debt or paying a lot of interest and taking out a lot of debt, and you're skeptical about buying a home, there's ways to pay it off sooner and to pay off with less interest. So even if you can't afford the or you don't want to rely solely on paying off the home in 15 years and being locked in at a 15-year mortgage where you're paying higher payments, you could take out a 30-year loan, but when you can afford to, make that extra principal payment right here that would be going towards the principal each month, and would making your payment a lot bigger, but it will save you money in the long run. And that's one of the things that I like. I mean, you're saving yourself by making that extra $1,000, which is a lot of money to be paying, but if you can afford it, that's great. You're saving yourself $106,000 in interest. So for that $200,000 home that you bought, when all is said and done, you paid $225,000 for it, close to $226,000. So if you have any questions, please feel free to leave comments. But like I said, this is just a great little spreadsheet that I use to calculate interest and principal and compare loans. Whenever I'm taking a loan out from the bank, I always like to check to make sure they did their amortization correct and came up with the right payment for me. So thank you and have a wonderful day.